Everything in this video is not financial advice. It's for entertainment purposes only. This is the central bank's balance sheet. This is the Federal Reserve's balance sheet. And as you can see, it's grown over time. Now, when the Fed says they're going to quantitative tightening, right, they're going into a stage where they're tightening. What this balance sheet is mostly bonds. They buy bonds from the federal government. And what they're doing now is instead of selling the bonds, they're just waiting until they expire and they're going to collect the money plus interest. So they're not actually selling into the open market. However, they do have things on their balance sheet that they might have to sell, but that'll come later down the road. I don't think we'll get to that point, but that's what they're saying. And you can see since they announced quantitative tightening, this hasn't gone up. This has just stayed sideways because they're waiting for the bonds to expire. And as they collect money from the bonds expiring, then we'll start seeing this decline happen, right? So this is Bitcoin compared to the debt. All right, and you can see back here there is some unwinding, and Bitcoin came down with it. There is some more debt brought onto the Fed's balance sheet and started moving upwards, and then this massive amount of debt expansion, right? That was the C19 lockdowns, right? So we had this massive spike here. And you can see Bitcoin's charts kind of moved with that. And then right here is when they announced that, tightening, right? And I think they announced it a little bit prior and then didn't start until like around here. And you see Bitcoin's price is correlated with the Fed's balance sheet.
And that means most everything that people own practically are going down practically because most people are in stocks and bonds, that kind of thing. The Fed's trade-off is going to be very difficult. Right now, they have a very restrictive monetary policy plan. I judge that by the supply and the demand for credit. So the federal government is going to run large deficits. So that means they will have to sell debt. They'll sell treasury bills and bonds. The Federal Reserve is planning to sell $1.1 trillion of debt also. Private investors are inclined, pension funds and so on. They're losing money while there's inflation, so they're losing buying power. They're selling. And there's a selling imbalance. And that selling imbalance means, because it has to balance with the buyers, that means a contraction in private credit, which means a recession. And so as I look through this, we're in a tightening phase where it's beginning to bite, but it's not really, it's barely begun because the actual rises in short rates have barely begun. It's started, the other things are rising. And that trade-off between growth and inflation is going to be very difficult. And that's why I believe that we've entered a period of stagflation, quite like the 1970s. And then we can't look at it alone.
This is how much the federal government is collecting in taxes. So this blue line down here is how much income the government's taking in. Well, how much they're taxing us. They're not actually doing anything to earn income. They're just taxing everybody else. So down here is this blue line. It shows you how much the government's spending. Now, the red line is the total expenditure, so how much the government is spending, right? So they're spending more than they're collecting in taxes. And you can see during these gray areas, which are recessions, each time you see one of these gray areas, it just means it's a recession. You could see that there was a decline in tax revenue and there is an increase in the expenditure. So the government tries to stimulate the economy by spending more money, right? And you can see each time it's kind of a little bit more drastic, and now we're headed to here. And if with everything that's going on in the bond market, the cost to borrow is going to move up substantially. So all the debt issued while yields are high, that's the interest rate they have to pay on that debt. Now, all the other debt, right, it was when they issued the bond, but now as interest rates spike, they have to actually pay a higher cost to borrow. And if this red line doesn't get below the blue line, then it's an absolute must that they have to issue bonds and borrow in order to pay for what they what type of entitlements and everything that they're paying for. So
you're talking about 500 basis points on a $22 trillion economy that has $1.1 trillion in extra treasury issuance, basically immediately over the next short run, that would have to be issued as receipts fall and as countercyclical payments rise in a recession. You would, unless the Fed came back in with sizable QE, because, oh, by the way, the Fed's supposed to be selling treasuries alongside that increase in treasury issuance. The U.S. is still going to be running $1.2 trillion deficit. And foreigners, with the dollar where it is, I don't know if people saw the TIC report last week, they're selling treasuries. The Japanese are selling treasury. The dollar's too strong. So who's the buyer? And the answer is it's either the Fed, if they don't want rates to rise or in a recession, or if they want to let rates rise in a recession, like they do in an emerging market economy with the balance of payments problems, then that's what the U.S. is going to have. If the Fed stands aside, we're going to see a recession with rates flat to up, treasury rates flat to up in the United States, which, when we're this indebted, is not very good for a recession. So to me, that's the Fed's worst nightmare. I don't think they want to get to that point where you have a recession with rates rising. I think there is very little chance. I think we've been saying that they're going to be done. They're going to have to pivot by the end of 3Q. We've been saying that for, I think, a couple of months now. And after the last 2 weeks, I would take way under on the end of 3Q22 when the Fed starts to pivot.
This is the 30-year yield. So as bonds sell off, the yield's going to rise, right? So if I have $100 bond and I collect $105 in 6 months, and I sell it and I drive the price down to $90, now the $105 is still locked in, so whoever buys it at $90 has a much higher interest rate. So that's why yields are spiking. They have an inverse relationship with bonds, and you can see with this chart, this starts out at 1987. And it's this long trend of staying underneath this trend line, and now suddenly we broke out of it. So when you have these larger macro scale charts and you break out of it, usually that's more reliable, as well as it's more of an explosive move when it actually goes through everything. So that's one thing I'm looking at. This is the two-year bond, right? Now you can see it's selling off here. Look how volatile this is becoming too, and bonds are supposed to stay relatively stable. And now this is the Fed's funds rate compared to the 2-year yield, and you can see the Fed just kind of keeps up with the 2-year bond. So the bond market is really in control, and the Fed follows along to make sure that it's doing pretty much the same thing that the bond market's doing, because they can't have bond market sell off. That would be very badly. You can see, look how closely correlated the Fed's actions are to the bond market. Now they might delay and stall a little bit. There's a little bit of a lag here, but you can see this is where we are right now, and they have to raise interest rates, so it's beyond this previous high. And if we were to draw a trend line with the Fed's funds rates, right, this is the last time something broke. So what happens when we get back up to there? Something else is going to break. As a matter of fact, we're already seeing things break. So it's very bad sign that yields are spiking right now. Nobody wants bonds. If the federal government's continuing to borrow money, they're putting bonds into the bond market, and now the Fed's not buying. Investors don't want to buy because CPI inflation is too high, so they're guaranteed a loss. So there's a lot less buyers, other than maybe financial institutions that are required by law to purchase, but still there's not enough there. They have enough bonds for their collateral, so there's no reason for them to add to it. And they might add a little bit to it when they need to, but there's no reason for it to be added. Now, this is Bitcoin's chart, right? If we look at just some of the actions, so this is when the Fed raised interest rates to the top, right? You can see this is a bottom for Bitcoin, right? And right here, when they started loosening it, that's when we started showing this bullish pattern. And then once they dropped it back down to zero, and then with all the spending during the C-19 lockdown, we had this massive run. So you could also see back here, this is when Bitcoin was first started, right? So Bitcoin's never really had a period where there's high rates, right? So I have high conviction that when we get up here, something breaks and the Fed pivots, right? So that's the goal, is we get back down to the zero level, something like this. We get up to here and then we go right back down and maybe even go negative. And I think that's an environment where crypto thrives, is if we had negative rates during that time period.
Things we've done, if you don't allow the defaults to happen, as we've repeatedly done, then the debt gets so big that it's no longer a choice the bondholders win or the bondholders lose. Now it's the bondholders lose by inflation or the bondholders lose by default. That's
right.
it.
It's the classic von Mises quote, right?
It's exactly destruction of the currency or walking away from it. And we're there. We're there. And so there's no easy, and that's why I say the first thing I would do if I was a politician is I'd resign, because
it's a no-win situation.
That's exactly it. I mean, there's like, why? I mean, if you want to be a politician over this, so sorry to
interrupt you. Let me ask this question, which has really flummoxed me. Why do you think Jay Powell signed back on again? He had a perfect opportunity to kind of slink out the back door.
I don't know. Who knows? I don't know. Dogma. I mean, the connections. I mean, he's rich enough. He doesn't need the headache, right?
Right. I'll tell you that the theory that I came up with, which I think you would disagree with, given what I've heard you say, is he may really, the only reason I could think of it is, hey, look, he knows how bad things are, and he doesn't want to be seen by history as a guy that was just one of a string of Fed chairs just running the train off the tracks. And he's serious about wrapping the Volcker mantle around him, and he's going to be the guy to do whatever it takes. But I think you would say, doesn't matter. It's a lost game at this point. He's literally just signing up to lose.
If he thinks he can do that, then we should all be in cash, because it's not going to work. He's going to blow up the stock market. He's going to blow up the bond market. He's going to blow up global sovereigns. He's going to blow up everything until he either cries uncle, or he stands aside. He stands aside and lets the U.S. government default on their obligations. And by the way, after the European Union does the same and Japan does the same, et cetera, you basically So now it's interesting when you spin it. When I say it like that, when you hear him saying things like there are things that could happen that could change the international status of the dollar in the global financial system, whatever he said last week, which had me scratching my head for a Fed chair to say that. Maybe this is part of a grand plan. I've consistently been naive to think that they understand things better than they do. Maybe this is one of those times that they actually do. I don't know.
Thank you for downloading the Lighthouse report. I look forward to doing more of these deep dives in the future.